So this is our first topic for the financial management, and the topic is financial statement analysis. Good. So how do you analyze the financial statement? Actually, the key tools for financial statement are mostly the ratio analysis. So basically, under this topic, we'll be discussing more about the ratio analysis. So I'll share with you the course outline for the same, for the financial management, the same way I did with the financial reporting. So we can write, let me see that. FSC, FSC, FSC. Yeah, FSC, that just means the financial statement analysis. FSC includes identifying, it includes identifying and analyzing, various financial statements of the company, identifying and analyzing various financial statement of the company, analyzing various financial statement of a company, various financial statement of the company, in order to determine the strength, comma, weaknesses, comma, opportunities and threats, So in bracket, yeah, that's what we call the SWOT analysis. Yeah, whereby you take the financial statement of the company, be it the income statement, statement of financial position, statement of the cash flow. Now, in these cases, you have the financial statement, you try to analyze them so that the company can be able to identify the internal factor, of which internal factor we have the strengths and the weaknesses, and then you also have the external factors. That is, for the external factor, determine any opportunity as well as the threats the company can face. Good. So now let's look at some terminologies. Number one, operating profit. Yeah, what do we mean by operating profit? See that? This refers to earnings. This refers to the earnings before interest and tax. This refers to the earnings before interest and tax. The earnings before interest and tax, in bracket, EBIT. Number two, what we mean by equity, and equity is also known as the net worth. Equity. You see that? This refers to the shareholders' funds. This refers to the shareholders' fund. This refers to the shareholders' funds. E.g., ordinary share capital, e.g., the ordinary share capital, share premium, retained earnings, and other reserves, retained earnings and other reserves. Number three, we have a net asset. Also, it's known as capital employed. Net asset stroke, also known as the capital employed. You see that? This is total assets, this is total asset, this is total asset, this is total asset minus current liabilities, total asset minus current liability, or equity or equity plus long-term debt, or equity plus long-term debt. Equity plus the long-term debt. Yeah, that's what we call the net asset. So you're saying that net asset, don't write it. Net asset is the total assets. Then we make any current liabilities, which is also equivalent to, you take the equity element, we also add the long-term debt. That's the non-current liability. What is that? You may say that the financial statement is classified into two. We have the assets part, then the equity and liability part. For the assets, we have the non-current asset. Also, we have the current assets. Then we have the equity and liabilities. And for liabilities, there are two. We have the non-current liability and the current liability. So therefore, to get the net asset, you take the total, and current asset and the current asset. So you take the total assets, you minus the current liability. That's how you get the net asset. Of which, if you take the total asset minus the current liability, remember the statement of financial position must always balance. So the residual must balance also with the equity plus the non-current liability. Now that's what you call the net asset or the capital employed. Good. Then we write an NB, we replace that. The key tools, or the key tool in financial statement analysis, the key tool in financial statement analysis, are the financial ratios, financial ratios. Good. So now we look at a subtopic now, financial ratios. Financial ratios. Right to say that? Ratios are classified into five. Ratios are classified into five as follows. Ratios are classified into five as follows. And number one, investors stroke valuation ratios. Investors stroke valuation ratios. Then number two, we have liquidity ratio. Then number three, we have the gearing stroke leverage ratios. Number four, we have the profitability ratios. And then lastly, number five, we have what we call the activity stroke efficiency ratios, stroke turnover ratios, also known as asset utilization ratios. Actually, those are the five classification of the ratios, whereby we're saying that we have investors or valuation ratios. Now, what are investor or valuation ratios? Now, these are the ratios which are used to determine the value of the company. Liquidity ratio, these are ratios used to determine how liquid the company is, or what we call the ability of the company to settle its short-term liability or obligation when they fall due. That's what we call the liquidity ratio. Then gearing or the leverage ratio, on the other hand, gearing or the leverage means the use of the debt in the capital structure. So therefore, they are the ratios which are used to determine how the assets of the company have been financed using the borrowed funds. Then we have profitability ratio, you know what's profit. And then we have activity or efficiency of the turnover ratios. Now, these are the ratios used to determine how well does the company utilize the available assets. So it's all about measure efficiency. How does the company utilize their assets? Good. So now let's start with the first one, investors stroke valuation ratio. Investors stroke valuation ratios. I have to say that. They are ratios. They are ratios. They are ratios. They are ratios used to determine the value of the company. They are ratios used to determine. They are ratios used to determine the value of the company. They are ratios used to determine the value of the company. So they include, number one, earnings per share. That's EPS. One is the earnings per share. Bracket EPS. Then we explain, see that this ratio indicates the profit available, to each share, held by the investor, each share held by the investor. Yeah, and how do you determine the earnings per share? Now, to get the earnings per share, you take the total earnings, or what you call the earnings attributable to ordinary shareholders, which is equivalent to, you take the profit after tax, you deduct any preference dividends, or which you divide by the number of ordinary shares. Number of ordinary shares. So to get earnings per share, take the earnings attributable to ordinary shareholders, which is equivalent to profit after tax, you deduct any preference dividend, and then you divide by the number of ordinary shares. Number two is the dividends per share. Number two is the dividend per share. Right to see that? This indicates the actual cash recommended or payable as dividends, payable as dividend to each share held, by an investor, Therefore, how do we get the dividend per share? So dividend per share, you take the total dividends declared and paid, then you divide by the number of ordinary shares. Number of ordinary shares. Or alternatively, to get the dividend per share, you can take the earnings per share You multiply by the dividend payout ratio. Dividend payout ratio. Reverse ratio is earnings yield, earnings yield, earnings yield. Earnings yield. Where to see that? This ratio indicates, the percentage of return. This ratio indicates the percentage of return, the percentage of return for every amount invested in the company, for every amount invested in the company, for every amount invested in the company, for any amount invested in the company, for any amount invested in the company. So it's computed as follows. It's computed as follows. It's computed as follows. So to get the earnings yield, you'll take the earnings per share over market price per share. And number 4, you have the dividend yield. Dividend yield. Okay, so that. This indicates the percentage returns. This indicates the percentage returns. This indicates the percentage return in form of dividend. This indicates the percentage returns. This indicates the percentage return in form of dividend, in form of dividend, in form of dividend for every amount invested in the company, for every amount invested in the company, for every amount invested in the company. Yeah, so therefore, how do we get the dividend yield? So to get the dividend yield, you take the dividend per share, you divide by the market price per share. Yeah, as you can observe is that for both yields, that the earnings yield and the dividend yield, the denominator is always the market price per share. Good. Then number 5, dividend payout ratio. Dividend payout ratio. You see that? This indicates the proportion. Dividend payout ratio. You see that? This indicates the proportion of the earnings, the proportion of the earnings available for distribution to shareholders, available for distribution to shareholder. Good. It's computed as follows. So how do we get the dividend payout ratio? Now, to get the dividend payout ratio, just take the dividend per share over the market price per share. So not the market price, but the earnings per share. Sorry. Dividend per share. Well, earnings per share. Yeah, that's what we call the dividend payout ratio. Or alternatively, to get the dividend payout ratio, you can take 1 minus the retention ratio. Retention ratio. Retention ratio means that, for example, if the company, if they make a profit and they have a policy of retaining 50% of the profit, they retain it to the retained earnings. So that means if they retain 50%, the other proportion of 50%, what will be paid as dividend. That's what we call the dividend payout ratio. Number six, a dividend cover. Dividend cover. And this dividend cover. So that this indicates the number of times. 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 Ordinary dividend. This indicates the number of times ordinary dividends is paid out. Ordinary dividend, the number of times the ordinary dividend is paid out from the available earnings. The number of times ordinary dividend is paid out from the available earnings. Now, how do you get the dividend cover? Now, dividend cover, you take the earnings per share, you divide by the dividend per share. Yeah, it shows the number of times you can pay the dividend from the available retained earnings. And then number seven we have is the price earning ratio. Price earning ratio. Price earnings ratio. So what's price earning ratio? So let me say that. This indicates the relationship existing between. This indicates the relationship existing between. This indicates the relationship existing between the market price per share, the market price per share, the market price per share, and the earnings per share. This indicates the relationship existing between the market price per share and the earnings per share. Full stop. It's computed as follows. It's computed as follows. It's computed as follows. It's computed as follows. So to get the price earning ratio, you present the market price per share. So you take the market price per share, you divide by the earnings per share. Divide by the earnings per share. I want us to do now some illustration. Do some illustration. So open with me June 2013, question 1B. June 2013, question 1B. I had shared with you the question papers. So June 2013, question 1B. Can they make an effort of having a hard copy of the past papers? Sorry? So open your head there. June 2013, question 1B. And we are told that so we are told that WX Limited shares has a nominal value of 80 shillings. Now, nominal value means the par value. The company pays 10% of the nominal value of the share as dividend for the year. So the question is, how much will be the dividend per share? So we are told that the company pays 10% of the nominal value of the share as dividend. We are told that the nominal value in this case is 80 shillings. And then kindly don't copy. I'll give you time to copy. So therefore, the dividend per share will be 8 shillings. The current market price per share is 160. So the market price per share is 160 with a 15% earning yield. So earning yield, we have it 15%. Required. Number one is the earnings per share. So number one, we compute earnings per share. So how do you compute the earnings per share? So I give you the formula on how to compute the earnings per share. You take the earnings attributable to ordinary shareholders, you divide it by the number of ordinary shares. In this case, we are not given the number of ordinary shares. We're also not given the profit. But we are given the earnings yield. How do we get the earnings yield? Here is the formula. So to get the earnings yield, you take the earnings per share, you divide by the market price per share. But the objective is to compute the earnings per share. So you make it the subject. So if you make it the subject, you just cross multiply. So therefore, to get the earnings per share, you take the earnings yield, you multiply by the market price per share. The earnings yield, we have it's 15%. You multiply by the market price per share, which is 160. So 16 plus 8, you get 24, right? Okay. Then number two of the question, we determine the dividend cover. So how do we get the dividend cover? Now see that dividend cover, it shows the number of times through which we can pay the dividend from the available earnings. So to get the dividend cover, we take the earnings per share, you divide by the dividend per share. Earnings per share is what we have computed in number one, which is 24. You divide by the dividend per share, and the dividend per share we have 8. Therefore, we have 3 times. Remember, I said that dividend cover shows the number of times through which the dividend can be paid from the available earnings. Then lastly, number 3, the price earning ratio. Price earning ratio. So how do we get the price earning ratio? To get the price earning ratio, take the market price per share, you divide by the earnings per share. We have the market price per share, which is 160. Divided by the earnings per share. That's what we computed in step number 1, which was 24. Give me that. Sorry? Yeah, 6.67 times. Or you can write it in ratio form. 6.67 is to 1. So now you can copy. November 2015. You try another one. November 2015, question 3A. November 2015, question 3A. Method that. The following information is related to Mogul Limited for the year ended that 1st of October 2015. So if you don't have the question, just reason I will read the question. So the following information is related to Mogul Limited for the year ended that 1st of October 2015. So we have the earnings yield, which is 25%. So the earnings yield we are given is 25%. Dividend for the year is 10% of the share nominal value. So therefore, the dividend per share will be 10% of the company's share nominal value. We know that the nominal value per share is 40 shillings. So therefore, it will be 10% of the nominal value, of which the nominal value is 40 shillings. That means they pay the dividend of 4 shillings per share. Then you have the market price per share is 150. So market price per share we have is 150. Requirement. The earnings per share. So number one, we determine the earnings per share. So how do we get the earnings per share? Now, if you're saying that in this case, we have to get the earnings per share, you take the total earnings, you divide by the number of shares. But that information is not available. But you can use a ratio to determine the other value. That is, we already have the earnings yield, of which to get the earnings yield is earnings per share over market price per share. So what we need is the earnings per share. So you make it the subject, you just cross multiply. Therefore, to get the earnings per share, you take the earnings yield, you multiply by the market price per share. So earning yield we have is 25%. You multiply by the market price per share, which is 150. 150, you divide by 4, you get that 7.5 shillings. Good. Number 2, the dividend cover, DC. I say that dividend cover, it shows the number of times through which we can pay the dividend from the available earnings. That is, you take the earnings per share, you divide by the dividend per share. We have the earnings per share, the one we have computed in number 1, which is 37.5. You divide by the dividend per share. So the dividend per share is 4. Now the question is, if you have to distribute all the earnings as dividend, you see the dividend per share is 4. So we can pay it how many times? So what is the ratio? Sorry? 9.375 times. Yeah, it shows the number of times through which you can pay the dividend out of the available earnings. So it can be paid 9.375 times. Then lastly, number 3, price earning ratio. Price earning ratio. So how do we get the price earning ratio? So it's the market price per share, you divide by the earnings per share. The market price per share you have is 150. The earnings per share you have is 37.5. Is it 4? Yeah, you get 4 times or 4:1. As simple as that. So you can copy. So now let's look at the second category of ratios, that is liquidity ratios. Liquidity ratios, liquidity ratios, liquidity ratios. Right, we see that? Right, we see that. They are ratios which indicate the ability of the company. They are ratios which indicate the ability of the company. They are ratios which indicate the ability of the company. They are ratios which indicate the ability of the company to settle its short-term obligation, to settle its short-term obligation, to settle its short-term obligation, to settle its short-term obligation. Good. They include number one, current ratio. Current ratio. They include number one is the current ratio. Do you see that? This indicates the number of times. This indicates the number of times. This indicates the number of times current liabilities can be paid. Current liabilities can be paid. Current liabilities can be paid. Current liabilities can be paid out of the current asset. Current liabilities can be paid out of the current asset. Current liabilities can be paid out of the current liabilities can be paid out of the current asset. Out of the current asset. Is determined as follows. Is determined as follows. So to get the current ratio, you take the current assets. You divide by the current liability. Current assets you divide by the current liability. Yeah, very well to see that. The recommended ratio is 2:1. The recommended ratio is 2:1 or 2 times. Or 2 times. Yeah, that's what we mean by liquidity. You think that it shows the ability of the company, how the company can be able to settle their current liability from the available, the current asset. And they think that the recommended ratio is at least 2 times. That means if you cannot be able to pay your current liability twice, that means you're facing your financial problems. Are you together? Yes. So we say that if you cannot be able to afford something twice, you cannot afford it. Are you together? Yes. So that's what we mean by that. Number two, we have quick ratio, also known as acid test ratio. Quick ratio stroke the acid test ratio. You see that? This indicates the ability. This indicates the ability of the company. This indicates the ability of the company. This indicates the ability of the company to meet its current liability, to meet its current liability, to meet its current liability, meet the current liability from its most liquid current asset, from its most liquid current asset, from its most liquid current asset. Yeah, so how do we get the quick ratio? To get the quick ratio, you take the current asset, you eliminate stock or the inventory. Then you divide by the current liabilities. Take the current asset, you eliminate the inventory, then you divide by the current liabilities. Now, how can you be able to afford to pay from the most liquid assets. Then what to see that? The recommended ratio, the recommended ratio, the recommended ratio is 1:1. The recommended ratio is 1:1. Also, then we can explain that. You see that? Stock is excluded. Stock is excluded. Stock is excluded because stock is excluded because it might be difficult to convert stock. It might be difficult to convert stock into cash immediately. It might be difficult to convert stock into cash immediately. Number 3, we have the cash ratio. Cash ratio. Is that? It indicates the ability. It indicates the ability of the company. It indicates the ability of the company. It indicates the ability of the company. It indicates the ability of the company to meet its current liability. To meet its current liability from its most liquid, assets, and short-term marketable security, and short-term marketable security, and short-term marketable securities, e.g., and short-term marketable security, e.g., treasury bills, e.g., treasury bills, commercial papers, financial asset at fair value, 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 etc. Financial asset at fair value, etc. So how do you determine cash ratio? You take cash and cash equivalents. Cash and cash equivalents. Then you divide by the current liabilities. Divide by the current liabilities. Good. So let's take a 3-minute break. Take a 3-minute break. We proceed. Look at that classification of the financial ratios. Number 3, the other category of ratio we have is the gearing stroke leverage ratio, also known as the capital structure ratio. Let us say that. They indicate the extent to which they indicate the extent to which they indicate the extent to which the company has borrowed funds, the extent to which the company has borrowed funds, the extent to which the company has borrowed funds to finance its assets, They include number 1, or number A, debt to equity ratio. Debt to equity ratio, also known as the capital gearing ratio. Capital gearing ratio. Capital gearing ratio. This ratio indicates the amount of long-term debt. This ratio indicates the amount of long-term debt. For every amount of equity, for every amount of equity invested in the company. This ratio indicates the amount of long-term debt for every amount of equity, invested in the company. Yeah, so how do we get the debt to equity ratio? So we take the long-term debt. Yeah, in short, we'll take the non-current liability. Then you divide by the equity. Then you multiply by 100%. Then we say that we recap. We say that long-term debt includes long-term loan includes long-term loan, comma, debentures, and preference share capital, So number B is the debt ratio, also known as the financial gearing ratio. Debt ratio stroke financial gearing ratio. So that this ratio indicates viability. This ratio indicates viability To reach the total assets, the ability to which the total asset of the company, the ability to which, the ability to which the total assets of the company, the total assets of the company have been financed by the liabilities, have been financed by the liabilities, have been financed by the liabilities, have been financed by the liability. So how do we get the debt ratio? Now, to get the debt ratio, you will take the total liabilities. Total liability. When you talk about the total liabilities, both the non-current liability and the current liabilities, then you divide by the total assets. Divide by the total assets times 100%. Number 3 is a fixed charge ratio. Charge ratio. Fixed charge ratio, let us see that. This ratio indicates the proportion. This ratio indicates the proportion of the total capital. This ratio indicates the proportion of the total capital. This ratio indicates the proportion of the total capital, which has a fixed rate of return, which has a fixed rate of return. This ratio indicates the proportion of the total capital, which has a fixed rate of return, which has a fixed rate of return, which has a fixed rate of return. So how determine the fixed charge ratio? So the fixed return capital, then you divide by the total capital times 100% times 100%. Yeah, now what do you mean by fixed return capital? Now, when you talk about the fixed return capital, ordinary share capital does not qualify to be a fixed return capital because the dividend keep on changing. But for preference share, it's always fixed. If it's a 10% preference share, you'll be receiving a dividend of 10. Also, debentures. Debentures always have a coupon rate attached to it. Now, that if you, for example, invest in a 10% debenture, you'll be receiving a dividend or the interest of 10% based on the nominal value. Loan does not qualify to be fixed because how you pay the loan on a reducing balance. So that means the interest you pay for the first year will be totally different from the interest you pay for the second year. So that means for the fixed return capital, you can interpret that like that. Fixed return capital, fixed return capital, fixed return capital include preference share capital and debentures. Include preference share capital and debentures. And debentures. So another ratio, and still under gearing, we have interest cover ratio, stroke. It's also known as time interest earning ratio. Time interest earning ratio. You see that? This ratio indicates this ratio indicates, this ratio indicates the number of times, this ratio indicates the number of times interest expense, the number of times interest expense can be paid, the number of times interest expense can be paid, interest expense can be paid from the operating profit, because the number of times interest expense can be paid from operating profit. So how do we determine that? So that one you take the operating profit. And remember, it's that operating profit is the EBIT. That is the earning before interest and tax. Then you divide by the interest expense. So the other ratio is equity multiplier ratio. Equity multiplier ratio. Equity multiplier ratio. Need to say that. This shows the relationship, and this shows the relationship existing between, this shows the relationship existing between equity and the total assets, the relationship existing between equity and total assets, equity and total assets, whereby you'll take the total assets divided by the equity times 100. So we can do an illustration. Open with me May 2012, question 4A. May 2012, question 4A. Why you put that? The following statement of financial position was extracted from the books of XYZ Limited for the year ended 31st of March 2011 and 2012. So we have the 2 years given the statement of financial position required. The total debt ratio for the year 2011 and 2012. Number 2 is a equity multiplier ratio and then the capital gearing ratio. So how do we determine that? So I complete those ratios. So we're evaluating for 2 years. We have 2011 and 2012. So 2011, kindly don't copy. Just resign. 2011 and 2012. Now we start with number 1. So number 1, we have to determine the total debt ratio. Total debt ratio. We mark the formulas under the gearing ratio. Under the gearing ratio. So how do we get the total debt ratio? It's also known as what? Yeah, financial gearing ratio, whereby you take, we see that you take what? The total liabilities, both the current and non-current liability, you divide by the total assets, then you multiply by 100. So for 2011, for the total liabilities, we have total current liability, which is 543. Then you add, below it there is long-term debt, which is 531. That's for 2011. 2012, we do the same. 2012, the total current liability we have is 540. Then you add, there is long-term debt, which is 457. Then all of it, you divide by the total assets. And we have the total assets. So the total asset we have is 33, 73, and 2012 we have is 35, 88. And then you express them in percentage. Now, what you can notice is that all the gearing ratios are expressed in percentage. So what do you get? What one? 84%. Yeah. 27%? 7%. Good. And number two of the question? Number 2. Equity multiplier ratio. Equity multiplier ratio. So how do we get the equity multiplier ratio? So that to get an equity multiplier ratio, you take the total assets, you divide by the equity times 100%. And we already have the total assets. The total assets for 2011 was 3373, and then 2012 was an amount of 3588. Then you divide by the equity. So we have the owner's equity, where we have the common stock. Now, common stock is the same as ordinary shares, and then we have the retained earnings. And the total here we have is 2299. Here have is 2591 times 100. This one you get one. So, 0.72%. 0.48%. Then last number 3, capital gearing ratio. Capital gearing ratio. You need to determine this, to know this terminology. You see that capital gearing ratio is also known as what? Which ratio is that? Capital gearing ratio. Correct. It's debt to equity ratio. Debt to equity ratio. And debt to equity ratio says that it's equivalent to long-term debt. So you take the long-term debt. That is the non-current liability. You divide by the equity times 100. Yeah, that's what it goes to equity ratio. So you take the long-term debt, that is non-current liability, you divide it by the equity. Now, in the statement of financial position, we have long-term debt. For 2011, you have it 531. And the other year, 2012, we have it an amount of 457. Then you divide by the equity. So you have the owner's equity, so you have the common stock, we have the retained earnings, and the total is 2299, then times 100%, that is 2591 times 100%. What do you get? This one is? Yes. 23.1. 17.64. 17.64. So you can copy. So I wish to stop there for today. So in our next session, we'll proceed from where we have left. So we'll still be discussing on the ratio. Make sure the next class you have a hard copy of this past papers.